Hi, in this lecture, I'm going to talk to you about the various techniques used in valuation of a company. So, the first, we see three different images. Let's understand each of these through the points. So, the first on the left is the discounted cash flow. As you can see, cash is flowing out of the tap. DCF is a common method of valuing a company. It involves forecasting what the cash flows will be and then discounting it at a discount rate, then dividing the total value that we get with the outstanding shares, and we'll see how that gets done. Next is the net asset value as per books, or the book value per share. So we see a lady holding a net and she's trying to catch notes, so that represents the net asset value. And then finally, the relative valuation. So we see in an image of various individuals and one in the center. So if you're trying to value one company, we take a look at the relative multiples of various other similar companies, and we look at primarily three different multiples: the P multiple, the EBITDA multiple, and the PB multiple. PE multiple is given the most weightage because it is calculated by dividing the market price per share by the earnings per share. So that earnings per share being what is really earned by an equity shareholder. The other multiples are also used, but they are used in the absence of a company which makes profit. So if there's a company which is having operating income but has made net loss, it's not better off. It will not have a positive EPS, and thus EBITDA multiple might make more sense in valuing such a company. Similarly, if a company is completely not making any profit, it might be better off being valued at book value. So that's when we use PB multiple. So let's look at each of these in a bit more depth. So first, in DCF method, the first step involves preparing forecasted income statement. Now there's no particular method which we follow in creating the income statement. However, looking at past trends and gauging the future targets of the company, an income statement can be prepared to arrive at the net income. Net income is then adjusted with certain non-cash items to arrive at what is known as a free cash flow. Ideally, we should be calculating free cash flows to equity, and then discounting the free cash flows to equity over the years at the cost of equity. Then to that we add the terminal value. The terminal value is the value which we calculate at the end of the forecast, assuming that the company will grow at a stable rate for the rest, for as long as, for indefinitely at least. And then once we add that to the free cash flows, discounted free cash flows to equity, we the resulting number then needs to be divided by the number of shares to get at the intrinsic value. Next, in terms of net asset value method, or the NAV method, we compute the net worth of the company. Net worth is calculated by reducing the total assets by current liabilities and any debt components, because we need to look at it from the aspect of the equity shareholders, and then from the net worth needs to be divided by the number of outstanding shares to arrive at the NAV. Again, NAV is something which you would probably not use ordinarily. It's a method which is preferable for maybe companies which are financial institutions and do not have too many assets being reported as at historical costs. Next is relative valuation. So relative valuation is an alternative to DCF and NAV. Over here, the first step is to find comparable companies within the industry. The next step is to look at the PE multiples of such company, and using those PE multiples arrive at the price that the market should price the company which you are trying to review based on the P multiple of the competitors. So this gives us an idea whether the company is being undervalued or overvalued. Apart from these methods, there's also something which is known as the PEG ratio. That is, the P ratio multiplied by growth is known as the PEG ratio. So that can also be used for gauging whether a company is undervalued or overvalued. So if a PEG ratio is under 1, is less than 1, it means that the company has potential to grow. So that is definitely something which we can do before doing any such valuation, because if the PEG ratio itself is greater than 1, then the company is already overvalued. There's no point going and doing a DCF and a relative valuation. Alright, so if you've found this video useful, I'd ask you to kindly subscribe to this if you're watching this on YouTube, and I'll see you in the next lecture. Thanks for watching. Bye for now.